Marie for the introduction. Welcome to Budget 2021. The new norm. Normally I'm looking down at 200 people having a lovely fry. This morning I'm actually looking at myself, so I think I prefer the former. This time last year, Budget 2020 confronted the main challenge then facing us being Brexit. 1 year later, little did we know that we would be dealing with the worst pandemic, global pandemic, while continuing to prepare for Brexit. For many, the uncertainty and anxiety about our lives and livelihoods is great. It is indeed a daunting time for everybody. However, the budget announced yesterday is to help people come through this crisis and to build a stronger and more resilient Ireland. Budget Ireland has focused on the short term. Apologies now, I'm just having some technical issues. There we go. Budget 2021 has a short-term focus and focuses exclusively on the coming year. It is a bridge to a better future. The budget was introduced by the Minister against a backdrop of two significant economic uncertainties, being the impact of Brexit and the continuing effect of COVID-19. There are a number of key factors underpinning Budget 2021. Firstly, that there will be no bilateral trade agreement between the EU and the UK. That COVID-19 will continue to be part of our lives for 2021. And it is unlikely that there will be a broadly available vaccine in 2021. As a result, there is very little in the way of tax reductions in this budget. And the key focus for the government is providing funds as support for government departments to intervene in vulnerable sectors, businesses and regions. So I'm going to take you through some of the supports that were introduced in the budget yesterday. So the first one introduced relates to a COVID restriction support scheme. This is a compensation scheme which will provide support for businesses whose trade has been significantly impacted or temporarily closed during COVID restrictions. The scheme will be available when level 3 or higher restrictions are in place. As things stand, we all know that we're currently in level 3 restrictions, so this scheme is effective from yesterday until the 31st of March 2021. At present, there are a number of sectors that are impacted by the restrictions under level 3, and these are accommodation, food, arts, recreation and entertainment. Where the government decides to move to a higher level of restrictions, other sectors may qualify at that time. The scheme will focus on business premises where the government restrictions directly prohibit or restrict the access by their customers. The support represents a cash payment in respect of an advance credit for trading expenses for the period of the restrictions. Payments will be calculated on the basis of 10% of the first 1 million in turnover and 5% thereafter, subject to a maximum weekly payment of 5,000. The scheme will operate on a self-assessment basis, and qualification will require a business to demonstrate that their turnover has been severely impacted by COVID-19. As a result, they will need to demonstrate that their turnover does not exceed 20% of its turnover for the corresponding period in 2019. So that represents a reduction of 80% in its turnover. Qualifying businesses can claim this support in week 1 of the imposition of the level 3 restrictions, and valid claims will be repaid for the entire period that the restrictions last. Within a 2 to 3 working days, it will be paid. It is anticipated that the first payments will be paid out in mid-November. It is estimated that this measure alone will cost 40 million for every week that we are at level 3 or higher restrictions. The costs from this measure will be met by the National Recovery Fund. As we're all aware, there have been a number of other supports that were in place. Initially, the temporary wage subsidy scheme was in place, which expired at the end of August 2021. This was replaced by the employment wage subsidy scheme. This particular scheme is due to expire at the 31st of March 2021. And the Minister has acknowledged in his speech that it would be very difficult to remove this support from businesses at the 31st of March, and has guaranteed that there will be no cliff edge on these types of support. There will be a new wage subsidy scheme put in place at the end of March, which will run for the year 2021. The government will decide on the form of this scheme when economic conditions are clearer. So moving on to some specific measures, as widely anticipated, the budget yesterday announced the reintroduction of the 9% VAT rate for the hospitality and tourism sector. This is to be reintroduced from the 1st of November 2020 to 31 December 2021. So you will note that it has a definitive time period. The reduction in the 23% VAT rate, which was introduced in the July stimulus package, is reduced from 23 to 21%. This is to remain in place until the 28th of February, but there was no further extension of it announced in the budget. Moving then on to debt warehousing scheme. As a lot of you are aware, there is an existing debt warehousing scheme available for businesses impacted by COVID-19 who are unable to pay their VAT and payroll liabilities as they fall due. The debt warehousing scheme has been extended for income tax for the self-employed. The Minister recognised that not all self-employed will be able to avail of a temporary loss relief measure that was introduced in the July stimulus package, and I will discuss that in a later slide. The debt warehousing scheme has been extended to include income tax liabilities that will become due by the 10th of December this year. As many of you are aware, the income tax filing deadline has been extended from mid-November to the 10th of December. Individuals will be able to warehouse the balance of their 2019 income tax liability together with their 2020 preliminary tax. By availing of this debt warehousing scheme, the rate of interest applied to the non-payment of this tax is greatly reduced. So for the first year, a 0% interest rate applies, and then a reduced 3% interest rate applies thereafter. In addition, there is no surcharge for late payment on these income tax liabilities. So this will be a significant cash flow benefit for those self-employed impacted by COVID-19. So the following example will just illustrate how it will work. So in 2019, I had a total tax liability of 40,000, and I had paid 15,000 on account in November 2019. So I had a balance of tax for 2019 of 25,000. In addition, I have an obligation to pay preliminary tax of 40,000 for 2020. So my total tax payment due on the 10th of December is 65,000. Unfortunately, I'm not able to pay this liability in full, and I defer it until the 1st of July 2022, and I pay it in full at that time. The interest rate that I pay under this new scheme, this debt warehousing scheme, is just over €1,000. If the normal interest rates, which run at around 8% per annum, had applied, my interest bill would have been around 8,000. So that is a significant saving for those people impacted. Moving on then to other non-COVID tax debts. In the stimulus package released in July, there is a reduced rate of interest that applies to non-COVID tax debts. So these are debts that arose before the COVID-19 period. As I mentioned, the interest rate on late payment of taxes is generally 8% or 10% for fiduciary taxes, which are your payroll taxes and your VAT. To avail of this reduced interest rate, a phased payment arrangement must be in place by 31st October 2020, and this must be agreed with the Collector General. Applications for individuals or businesses can be made through Revenue's online system. And just one other point to note in relation to debt warehousing, it has been extended also for companies that, following a review of their temporary wage subsidy scheme by Revenue, where they find themselves in a position that they have to repay it, they can also avail of debt warehousing in respect of that liability. Again, this is a July stimulus package, and it's an important one to note, particularly with the income tax filing deadline coming up shortly. So this provides for a temporary income tax loss relief. So for individuals who are self-employed, you can elect to claim your 2020 losses and certain unused capital allowances as a deduction against your 2019 profits. There are certain conditions around it, and there is a maximum claim that you can make equal to 25,000. Where you are trying to determine where your 2020 loss position will end up, you are permitted to make interim claims. Separately, there's a tax relief available for farmers. They have the option to step out of income averaging for the 2020 tax year. Moving on to remote working. This has now become a norm of business and how we operate our businesses today and possibly in the future. The Minister yesterday gave a commitment to develop a strategy for remote working and remote service delivery. And while in yesterday's budget there were no new measures introduced, the Minister took the opportunity to announce to remind us of existing reliefs that are there. At present, if your employees are working from home, the employer can pay up to $320 per day to cover the cost of electricity and heating bills, and with effect from 2020 that can also cover broadband. Alternatively, an employee can make a claim direct to the Revenue Commissioners where they are working from home. And they can do this on their income tax return by a direct application to the Revenue. Separately, just one thing to note, there are no benefit in kind implications where your employer has provided home office furniture. So this includes laptops, printers, chairs, desks. So that's a very welcome measure to know that it exists there. So moving on to income tax. As widely anticipated, there was no changes to income tax rates. There was no changes to the standard rate band. There was a small adjustment to USC and some very minor changes to tax credits. The earned income credit, so this is effectively the PAYE credit for those who are self-employed. It was introduced in 2016, and 2021 will see where it now equals the PAYE credit. So it is increased to $1,650 from $1,500 in 2020. The dependent relative credit is being increased from 70 to 245 euros in 2021, and this is available where you maintain a relative at your own expense in your home. And as another small change to tax credits relates to seagoing naval personnel. So this tax credit has increased from $1,500 to $1,500 from $1,270 in 2021. This was first introduced in 2020 to permanent members of Irish Naval Service who spent 90 days plus at sea. As I mentioned, there were some small changes in relation to USC. And this is to ensure that individuals who are on the minimum wage are not impacted by the increase in the minimum wage being introduced on 1 January 2020. So the second USC band, the 2% band, is being increased by just over €200 to reflect this. In addition, the reduced rate of USC for medical card holders is being extended for a further year. This applies for their total income is 60,000 or less. So they pay the first 12,000 of their income at 0.5% with the balance at 2%. In addition, there was a small change to employer PRSI, again to reflect the change that has been made to the minimum wage being increased on 1 January 2020. And again, it ensures that those individuals on minimum wage, that the employer continues to pay employer PRSI at the 8.8% rate. Moving on to corporation tax updates in the budget. The Minister acknowledged in his speech the significant contribution made by corporation tax receipts to date in 2020, playing a vital role in funding expenditure measures introduced in response to the pandemic. In this context, the Minister reiterated the importance of maintaining a stable and transparent corporation tax regime and reaffirmed Ireland's strong commitment to the 12.5% rate. He also spoke about the corporation tax roadmap, which I will deal with on the next slide. And just as an FYI, as we're all aware, the Apple case ruling, the EU court overturned the Commission decision in relation to the 13.3 billion of alleged state aid, and there is a further appeal to be lodged, and this could take up to 2 years for it to conclude. The Department of Finance published its corporation tax roadmap in September 2018. The roadmap is a useful guide to the timing and approach to the implementation of broad-ranging tax changes resulting from EU and OECD initiatives, and has provided greater certainty for taxpayers on the direction of the Irish tax regime. The Minister confirmed that he will arrange for the Ireland's corporation tax roadmap to be updated, which will reflect the actions that have been taken to date, and will also highlight areas for further review and consultation in the coming months. Some of the future changes that are on the horizon, one relates to the OECD's BEPS project around dealing with tax challenges of digitalisation in the economy. It will propose a framework for changes to international tax in 2 pillars. One, the taxation of profits of multinational, linking tax nexus to location of customers, which is a move from current transfer pricing provisions. And separately, it will ensure that there is a global minimum CT rate for multinationals who have income in excess of 750 million. It will also, next year, we'll see changes in how global and EU corporation tax operates, and it is expected that it will impact Ireland negatively, but those changes will be made in 2021. Some specific corporation tax measures introduced in the budget. So the Knowledge Development Box. This was introduced in Finance Act 2016, and it provides for a reduced rate of corporation tax for profits derived from the development of IP. The scheme was due to expire and has now been extended to December 2022. There has also been an extension of the Accelerated Capital Allowances scheme for energy efficient equipment. Again, the scheme was due to expire and is now being extended to December 2023. The Minister will also conduct a review of what assets currently qualify for these reliefs. There's been a small change to our specified intangible assets regime. For any assets acquired on or after 14th of October 2020, they will now fall within the remit of the balancing charge provisions on disposal. So they were previously outside the scope of a balancing charge event. This is to align it to international best practice. Separately, The government will carry out some work on the development of a digital gaming sector tax credit. This will be developed in 2021 with a view to being available to claim in January 2022. There's very little detail available on this, and we'll know more next year. It's intended to support employment in creative and digital arts sector. Again, a small change in relation to the film tax credit. There's a tax credit available equal to 32% of the eligible Irish spend. However, if the work is carried out outside of the normal film hubs, which is Dublin, Wicklow and Cork City and County, if you carry out your work outside of those areas, you're entitled to additional 5%. This has been extended to 31 December 2021 and will be phased out over a period until December 2023. Again, introduced in the July stimulus package, there is a 2020 loss relief for companies that whereby your 2020 losses can be carried back against your 2019 profits. The maximum amount that you can claim is 50% of your 2020 losses. Once you've finalised your 2020 position, which would normally be mid-2021 and due for submission in September 21, if you have further losses, these can be carried back as normal to 19. So moving quickly on to some other tax changes. There was a lot of talk in the media of potential changes in rates of CGT and potential changes in reliefs, but there was no changes. So the 23% rate of CGT and CAT remains. There was no changes to the CAT group thresholds. There was a small change to CGT Entrepreneur Relief, and there was some targeted CGT anti-avoidance measure on foreign exchange loans, which were used to create an artificial loss. A lot of you are familiar with CGT Entrepreneur Relief. It provides a 10% rate on the disposal of qualifying assets, and there are some conditions to be satisfied, one of which states that you need to hold a minimum 5% shareholding for 3 of 5 years ending on the disposal of those assets. The change introduced in the budget is that you no longer need to own that minimum 5% shareholding for 3 out of the 5 years ending with the disposal. It can be any 3-year period. Unfortunately, there has been no relaxation of the full-time working director requirement, and it's understood that this change is intended to encourage business owners to expand their business, but not necessarily to benefit passive investors. The change is effective from 1 January. There's some small changes to stamp duty, so consanguinity relief. This applies to the transfer of farmland between family members. And it provides, where the relief applies, a stamp duty rate of 1% versus 7.5% applies. Again, this relief was due to expire and is now being extended to December 2023. In addition, there is a farm consolidation relief, which applies a 1% stamp duty rate on the disposal, purchase or exchange of lands between farmers for the purpose of consolidating their existing farm. Again, this has been extended to December 2022 to align with CGT relief. Moving then on to the stamp duty residential development refund scheme. This is a relief where you acquire non-residential land and pay stamp duty at 7.5%, where the land is subsequently developed for residential purposes and the construction was completed in 24 months. It was possible to get a refund of stamp duty to ensure that the overall effective rate was 2%. The main changes, the relief is now being extended to 31 December 2022, and it will apply for developments that are completed by 30th of June 2025. Therefore, you now have a 30-month period to complete your development. The Help to Buy scheme has been extended to 31 December 2021. The July stimulus package improved this relief, whereby the relief is now available to the lesser of 10% of the purchase price, or your income tax and dirt paid in the last 4 years, or 30,000. And as you are aware, it applies to first-time buyers and new houses and self-builds only. There was a small change in relation to VAT. The flat rate addition increased from 5.4% to 5.6%. and that's effective from 1 January 2021. Moving then on to the climate and environmental issues. And again, given the current economic climate, this might have been an easy pass in the budget, but the government reasserted their commitment to look at climate action. And the changes in the VRT and motor tax and fuel are part of the government's climate action commitments and aims to incentivise motorists to move away from higher polluting vehicles. So the first change is an increase in carbon tax. It is increased by 7.5 euros per tonne to 33.5 per tonne, and further increases of 750 per annum up to 2029 envisaged. We would have seen driving in this morning that our petrol and diesel has now increased. However, the increase in home heating oil has been deferred until May 2021. There's also an increase in the old reliable pack cigarettes. It's been increased by 50 cents, and a pack of 20 cigarettes now costs 14 euros. Moving on to the new VRT scheme. So the reforms have been introduced in the context of the transition to the new worldwide light test procedure for emission testing. From January 2021, a new enhanced VRT table is being introduced to use the CO2 values from the WLTP for emissions testing for passenger cars, and to strengthen the environmental rationale of the VRT regime in line with government's commitment to reduce emissions from road transport. Under the current VRT scheme, they range from 14% to 36%, and under the new table, VRT will range from 7 to 37%. Overall, the existing 11 bans for VRT will be replaced with 20 VRT bans. So the lowest VRT rate will be 7% for a car with the lowest emissions, while the highest rate will now be to 37% for a Guzzler. As part of this, to create a fairer VRT scheme, any reliefs and incentives for buying hybrid electric vehicles, these will expire as they will now be much lower under the new scheme. There's also an adjustment to motor tax. From 1 January 2021, a new motor tax category is being created for cars registered with the WLTP CO2 value. Going forward, from 2021, there will be 3 motor tax tables in operations. For cars acquired before July 2008, they will continue to be based on engine size. For cars registered up to 31 December 2020 and any cars registered after January 2021, which are NECD test only, there will be a slight increase in the motor tax tables, and then the new table will apply to the WLTP tested cars registered from 1 January 2021. So, in summary, there was limited tax measures announced in the budget. There was 270 million in context of the overall budgetary package of about 18 billion. There was in relation to COVID-19, there was a large range of supports announced for affected businesses, and the reality is these are the backbone of our domestic economy. There was an emphasis on climate change with the modification of VRT and motor tax, and this is obviously a step in the right direction regarding our climate. Budget 2021 is a lifeline for vulnerable businesses and a bridge to a better future. Obviously, there are significant challenges that lie ahead for future budgets in trying to repay this debt, while also trying to introduce measures to improve the competitiveness of Ireland's tax regime. I'll now hand over to Simon, who will take us through his economic analysis of the budget.
Thanks very much, Fiona, and good morning, everybody. If you could just bear with me for 1 second. Okay, can people see the screen okay? Great. Good morning, everybody. Thanks very much for joining us this morning, and for those who would normally be in the Sheraton Athlone, it's a shame we can't share the room together this morning, but it's good that we can do the catch-up virtually in any case. And this morning, I want to just cover three bases, really. One is I'd like to provide some really important context around Budget 2021, which comes via a summary of some of the key features of the economy's recent developments and recent developments in the public finances themselves. I'm going to share some brief thoughts with you on some of the main features of the budget and the plan and the strategy that underpins it, and then finish by discussing the extent to which the measures announced so far in response to the pandemic are affordable in the short and medium term. So there's a fair bit to get through, so I've one eye on the clock, so I'll go through this relatively quickly so we can try and have some Q&A at the end. So I guess it's really important to acknowledge and recognise that the economy was hit by the pandemic shock when it was doing relatively well. And by which I mean the economy was effectively at full employment and the public finances had been returned to balance, as regular attendees at this event will know. And that's not an academic point. That's a really important part of the context, because if you're going to get hit by any shock, especially one as severe as the one that the Irish economy has been facing, it's as well to have that happen at a time when you're doing relatively well, rather than when you're weak and vulnerable in general. And that also applies not just to the economy and its labour market, but also to the public finances. So the really strong improvement that successive governments have engineered from the depths of the last crisis means that the starting point fiscal position was actually one of surplus. Many measures of surplus, especially underlying surplus, have been actually in looking relatively strong and healthy over the last number of years, and that's a pretty reasonable place to start from, and that's really important, I think, both of those points. But of course, as we all know, we went from February of full employment to early May, where 600,000 people had moved from being in employment to reliant on state income support via the pandemic unemployment payment. And that's just a shock without any kind of precedent. It's just impossible to try and contemplate how we might have thought anything like that could have been remotely possible. And of course, it's definitely the case that not all sectors have been affected the same way. We, I guess, have acute stress in a number of really important domestic-facing sectors, notably hospitality, but also in retail, as well as some kind of support sectors that provide business support for the economy generally. And important to recognise that even within some of those sectors, there can be mixed experiences. So within retail, while people obviously have spoken about retail in general, it actually captures a wide range of different disparate experiences, ranging from grocery, which had the strongest period in its history during peak lockdown, as people pivoted towards buying grocery items instead of alternative forms of consumption. And then at the other extreme, you've got the hospitality, retail sales and bars got absolutely pummeled and remain obviously really weak and challenged. But that sectoral composition of the shock is also important in highlighting some areas of resilience. So, for example, parts of the multinational sector, including tech, and some parts of the manufacturing industry, including pharma and chemicals, have shown really important resilience. In other words, they weren't anywhere near as badly impacted as other more domestic-facing sectors. And one consequence of that is that the overall hit to the Irish economy has been nowhere near as bad as many other European countries. So the hit to our overall output, our GDP, was among the lowest of all European countries. And that reflects the really important resilience which is provided by some really strong, financially strong parts of the multinational sector, where the shock, if anything, has been something of a proof of concept for many firms in the tech sector. And in fact, on average, foreign-owned multinationals experienced an increase in their output levels in the first half of the year. But we know that isn't really truly representative of the economy more broadly, including many domestic-facing sectors. And so, for example, consumer spending suffered really severe weakness across the first half of the year. And in fact, the hit to Irish consumer spending was amongst the most severe of European countries. And that partly reflects, I guess, the government's conservative approach in imposing public health restrictions to try and manage the virus. And one consequence of that is the relative weakness of some parts of our domestic economy, including consumer spending. More encouragingly, though, in the same way that the numbers on the pandemic unemployment payment have fallen really, really sharply from 600,000 to about 230,000, we've seen a really strong and better than expected turnaround in indicators of consumer spending. So in many respects, the turnaround in consumer spending has been tracking a V shape. In other words, we've seen a really sharp recovery from what were admittedly really, really depressed levels at the low point in April. But since then, retail sales have come back really, really strongly. And in fact, on the latest numbers are running about 9% higher than they were in February. So that's, I think, really encouraging and speaks to, I guess, different phases of this shock having taken hold. So we had the acute phase, which culminated in the peak stress point when lockdown was at its broadest and most extensive in kind of April, early May. And then as the economy was released from lockdown, in some respects, we've seen evidence, I think, of a stronger than expected recovery. And that's reflected in the forecasts underpinning the budget, which were revealed yesterday. And just very briefly, if we just look at, say, the 2020 forecast for GDP, just as a summary point to tell the story. So back before all of this happened, the Irish economy was expected in overall terms to grow by about 4%. Then as the department and the government was trying to get its head around, like many forecasters, about how bad this might get, then when they went to revisit the forecast, they were anticipating a drop in overall output of over 10%. But because of that better than expected kind of recovery phase that we've seen over the summer, when it came to the budget forecasts, they were revising that sharply higher. In other words, the current expectation is that overall output might drop by only about 2.5%. And while a huge part of that story is the export sector, the multinational stuff, which has been so financially resilient, it's also worth highlighting that consumer spending has also been upgraded, even though it's still expected to record a really sharp contraction for the year as a whole. But the extent of the weakness is much, much less pronounced compared to where the department thought it might be when it did its previous forecast in April. And then maybe just to touch on the fact that the outlook for next year is relatively conservative, in the sense that the two key underpinning assumptions, as Fiona touched on, are: one is that there is no deal between the UK and the EU, and secondly, that we're living with the pandemic throughout 2021 on the basis that there won't be an available vaccine. So a degree of conservatism and potentially with some justification, I think. In terms of what this all means for the public finances, I think the government does deserve a considerable amount of credit. It has responded really aggressively. The level of overall departmental spending is going to be about over 16 billion euros higher in 2020 compared to where they were originally planning. And to put some context around that, that is going to result in overall spending in the government sector rising by about 22% in 2020. There is no precedent for that kind of fiscal expansion. And so I think there's a lot of kind of confused thinking about exactly how to capture, you know, the extent to which the public finances are benefiting from stimulus. I think for me, that's probably the most direct way. Overall non-interest spending rising by over 20%. Which is something we've never seen before. One of the things that's really significant about that is that the contrast between the fiscal response that was needed because of the weakness of the economy and the weakness of the public finances during the last crisis, when we needed to have 5 years in a row of contracting spending to respond. So the contrast couldn't be more stark, and that's a really, really important point of difference in thinking about the way that the government and the fiscal response here is evolving compared to past experience. And there's one other point I'll make on that in a second. But we've also seen a hit to the revenue base. Obviously, when the economy goes through that amount of stress, revenues are going to suffer, albeit that the amount of downward pressure on tax revenues hasn't been as strong as was originally expected. So back in April, the government was expecting a drop in tax revenues of about nearly 10 billion. It turns out it's going to be about 7.5. It's going to be only a drop of about 2.5. So in other words, compared to as recently as April, the coffers are looking better, to the tune of over 7 billion euros, and that reflects the buoyancy of corporation tax, as well as the fact that the sectors most adversely impacted in this shock are actually relatively low-paid sectors. And when you combine that with how progressive the Irish taxation system is, in other words, how little tax is paid at really low income levels, we've seen, I guess, a better than expected outturn, not just on corporation tax, but also actually on income tax. And that has definitely helped underpin the revenue side of things, albeit that revenue has bucked the trend of recent years and is going to decline this year. So that provides the context around Budget 2021. What about the budget itself? And here, and people who've attended this event in the past will know that I've been critical in the past about the way that some of the information is presented, because it can be really, really difficult to identify what is truly new news in the plethora of information that gets dropped on budget day. And I think yesterday was a case in point. So the ministers were unveiling what they were referring to as a budgetary package of 17.75 billion euros. In reality, a lot of the heavy lifting was done before either minister rose to his respective feet yesterday. In other words, what they're indicating as 17.75 billion is really capturing two different things. There's a carry forward of measures that have already been put in place of about 10 billion, coupled with about 7 billion of new measures, which were revealed yesterday, if you know what I mean. So just to highlight that, but in terms of maybe trying to understand where the resources are being allocated more generally, there's obviously 8.5 billion next year is going to be assigned to addressing COVID challenges. There's going to be additional funding for existing services of almost 4. There's a significant uplift in kind of core underlying capital spending, as well as a recovery fund. And I think what's welcome about this from a business perspective is that at its heart, there are a number of really important business supports here. Fiona has touched on the COVID restrictions subsidy scheme. The extension of the wage subsidy scheme is also really, really important, as is the cut to hospitality VAT. As well as additional measures for Brexit. So I think the ministers are covering a lot of really important bases there. The one point I would make just about the structure of what they're putting in place for next year is you can see that effectively 5.5 billion of that is unallocated. It's for unspecified measures. And while I think some of that is really understandable, because it's important that they have the flexibility to respond, it will also be important for them to follow up with some further detail, so that those resources get deployed to support the business sector, that they're not just notional concepts. We want to give them life, and so hopefully they will put them in place sooner rather than later in effective ways. I want to just reinforce one other point on what was good about the budget, and I touched on this earlier, but hugely important to flag that one really significant difference is in past crises, the first thing to get chopped in the fiscal response was capital spending. And so we have effectively been kind of paying the price for this over the last half a decade or so. In other words, the underinvestment that took place during the last crisis. The government has learned, I guess, from past mistakes here, and it's a really welcome feature of it. People who've attended the event in the past will know that during the crisis, I was critical of the fact that government spending on capital projects had been cut so severely, and that's not the case. They have reaffirmed their commitment for capital spending, and that's really, really welcome. And so the overall position here is that we had been in surplus. Overall budgetary balance was actually in place for the last 2 years, but obviously the combined effects of what has been announced this year, coupled with the new measures unveiled yesterday, means we're now looking at sizable deficits, about 6% of GDP or about 10% of gross national income, maybe a better measure. But either way, these are sizable deficits, albeit not quite as extreme as was seen in the last crisis. And I guess one point to flag, though, is that the one consequence of running those deficits and choosing to run them and being proactive about counter-cyclically trying to support the economy is that instead of continuing to decline to more sustainable levels, debt is now going higher in the short term. In other words, ramping up borrowing does increase debt over time, and that raises the question about how affordable these deficits are. And the answer is, in the short term, they are affordable without much reservation, because while our debt level is high, the carrying cost of that debt is actually low. In other words, the burden that high level of debt places on the economy in terms of what it takes to service it is actually relatively low, and that's a huge function of the significant drop in interest rates that has been sustained over many, many years but most intensely, I guess, over the last year or two, especially even over the last 6 or 7 months, when the ECB has put really extraordinary supports in place, which have meant that as big as the shock is, as extraordinary as the fiscal position that we now face, the Irish government can borrow for 10 years at negative interest rates. So the NTMA has borrowed over €3 billion this year on the markets for 10-year money at less than zero rates. So that means that higher debt levels are much more affordable than we could have dreamt of, 10, 15 years ago. But we don't get a free pass on this. There are vulnerabilities in the public finances. Our reliance on corporation tax has never been higher. The share of total taxation accounted for by corporation tax has doubled over the last 8 years or so. And when you take that in conjunction with the fact that we had a high debt level going into this, and the economy does remain vulnerable to downside shocks, including what might happen with the virus, the extent to which restrictions might need to be further tightened and sustained over a period of time. So we can't presume that we're going to be able to rely on permanently low interest rates, or that we can just assume away concern about some of those vulnerabilities. We're going to need to put a plan in place that addresses some of those vulnerabilities and gets the public finances back onto a more sustainable path. And while that was understandably not the focus for this year or this year's budget, it will be important for the government to return to that question. And in fairness, they have indicated that they're going to do that as part of their updated fiscal strategy, which is due to be unveiled by April of next year. So we will need to see what that plan looks like, so that we don't end up in a problem whereby markets begin to doubt the commitment of the Irish state to fiscal sustainability. And so that is going to be a really important point for the government to follow up on. But for the time being, it's the extraordinarily low levels of interest rates that make all this doable, combined with, I guess, the really healthy starting position for both the economy and the public finances. So I've got one eye on the clock. So I think, just in the interest of time, I'll finish up there. Maybe just conclude by offering, for anybody who'd be interested, just feel free to get in touch with us. My colleague Ricardo Amaro would be delighted to get an email from you if you'd like to be added to our distribution list for our weekly or our other commentaries. But in the meantime, thanks for listening, thanks for your attention, and more than happy to take any questions. Thanks a lot. Sorry, I beg your pardon. My bad. I'm due to hand over to the president of Athlone Chamber of Commerce, Alan Shaw. So apologies, Alan, and thanks for bearing with me there.
Well, good morning, everybody, and certainly I've really enjoyed listening to Simon and Fiona in particular in relation to the detail of the budget. And my focus this morning is going to be more on what we can do as businesses ourselves, and indeed having a quick look at how SMEs have been affected in recent months. So first of all, we look at the backdrop. We look at the backdrop to what is the backdrop to the budget and the experience of the SME sector. So we're going to look at the survey that was conducted there by Chambers Ireland in September, and some of the key outcomes from that. As expected, no doubt the results are particularly stark for the SME sector, with a 30% decline in turnover reported, and 47% of firms that issue invoices are having difficulty in getting paid. And indeed then, with invoices older than 90 days represented 40% of many of the debtors. So as you can see there, the SME sector has been at the stark end of the pandemic and have experienced particular difficulties. And of course, the sectors that were worst affected being education, arts, culture, recreation, hospitality, and real estate. So if we look a little bit then at moving forward into winter 2020 and spring 2021, in terms of looking ahead, I think it's really important for businesses to get back to basics, and in focusing on your own businesses, to look at budgeting and managing your cash flows particularly carefully. I think that despite the huge uncertainty that there is at the moment in the context of both Brexit and COVID-19, it is important to continue to look at the numbers in your business on an ongoing basis. I think during a crisis, you really learn the true value of cash. And I think that's why it's important to keep the minds focused on looking at your numbers. I've been informed then having management accounts prepared regularly is extremely important. And that helps us then in our decision making and making regular decisions. I know that over the last 6 months, I think we've really found out that we can make the big decisions when we need to. By being informed, having the financial information at your fingertips in terms of management accounts, your budgets and your cash flows, I think it really helps, particularly for smaller companies where maybe you don't have a broad management team with all of the expertise around you. It's important that when you are making decisions that you have the right information there on your fingertips. It's also important, I think, to reach out. Remember, you're not alone. You have your financial advisors, Chambers Ireland, and all of the network of chamber organisations throughout the country are there to assist, and other business organisations and the local local enterprise offices. So I think it's important to, despite the fact that it's difficult to maybe attend conferences and physically be present at networking events, I think it's important to continue to use online platforms and share information with businesses in similar areas and so on. So then if we just look a little bit at the chamber network, Chambers Ireland and indeed all the various chambers of commerce throughout the country represent the largest business organisation in the country, and Chambers Ireland in particular focus on lobbying government in relation to policy making, and indeed had a significant role to play in many of the outcomes of Budget 2021. The Chamber Network also supports SMEs, facilitates trade, and leads a number of different campaigns. And every year, in advance of budgets and indeed any general elections and so on, the Chamber Network engage in various campaigns to ensure that we get the best outcomes for businesses, and in particular the SME sector. We find that in many of the networking events that we hold year in, year out, that approximately 60% of our members actually do business at the events. So it is a very kind of important way of engaging with other businesses and getting new business from time to time. So with that, I'm just going to leave you then with our contact details, both for Athlone Chamber of Commerce and indeed Chambers Ireland. If you wish to contact us, I would encourage you all to join your local Chamber of Commerce in advance of 2021 and contact us if you need help, and indeed all of the other agencies like Leo and your business advisors. So I'm going to hand you back now to David Gleeson for the questions and answers session, and thanks for listening to me.
David's on mute there.
Apologies.
So David, maybe I'll go through some of the questions that have come through online there. Some of them seem to be... Sorry,
you're back now, yeah, sorry. My mute button wouldn't work. Sorry, yeah, thanks, Fiona. Couple of questions. First one, a tax question for yourself, Fiona. Can an employee claim their full broadband, electricity, heating, or the $320 per day if claiming directly from revenue and the tax return?
Yeah, so if the employee is making the claim directly themselves to the revenue commissioners, On Revenue's website, they have outlined a basis for somebody to claim it, and it's 10% of total cost. So that would be the basis of a direct claim.
Okay, thanks Fiona. Question maybe I'd throw to Simon. Simon, you're on mute there, just to, hopefully you don't have the same difficulty with me trying to unmute. Question about Brexit, which hasn't gone away. What advices should we give to businesses to prepare for Brexit? It's just around the corner.
Yeah, absolutely, David, and thanks for the question, because it is, I guess, at times it can be difficult to recall that, firstly, Brexit has already happened, so the UK has left the EU. And what that means is, irrespective of whether there's a deal or not in the coming weeks, and hopefully there is, but irrespective of whether there is or not, there will be big changes coming in the trading landscape between the EU and the UK. And what that means for Irish businesses, especially SMEs, is that they need to really ramp up the preparation for that, because that change is happening. Really, all we're talking about is the extent of the disruption and the extent of the problem. So obviously what we want to avoid is a scenario where there's large tariffs and potentially quotas, which would really add seriously to the headaches, especially for sectors that are really important to the Midlands, including agri-food. But either way, there are going to be customs checks coming. And what that means is that people need to be proactively making sure that they have a thorough understanding of all aspects of their supply chain. So, and that really applies not just to exporters, which I think has been a lot of the focus. It also just as much applies to importers, people who might have a dependence on importing stuff either directly from the UK or from the continent via the UK. So the advice is really redouble your efforts to understand exactly where you're getting your goods from, where you're selling them to, register with revenue for customs purposes, and make sure you have a thorough understanding of all, not just the potential tariffs that would apply, but the documentation that you'll need irrespective of whether there's tariffs, and also to understand any regulatory compliance documents that you might need to adhere to different standards that may apply in the UK post-departure. So really important for people to not presume that things will be okay if there's a deal. There are big changes coming. And what we observe among our own kind of client base and from our interactions with stakeholders is that some of the larger companies have made much better progress in advancing their preparations, and it's smaller SMEs who potentially face a kind of a bigger gap in terms of their preparedness. So it's not too late. I think it's really important for people to really redouble their efforts to advance their preparations because big changes are coming.
Thanks, Simon. Maybe this question I'll ask Alan to comment on it. It's just what small steps and suggestions that you have that maybe business people should do to help themselves and the fellow business owners in these challenging times trying to cope with COVID and with Brexit coming down the line?
Yeah, well, I think one of the key things that Chamber networks throughout the country do on an ongoing basis is encourage businesses to shop local, to use the services and goods that are available locally to keep the business in the community, and like that all leads to further economic growth and so on in the local area. It all has a spin-off effect. I think other things that businesses should do is keep in touch with their local networks. Even though we can't physically be present at networking events and so on, they are a key way of gaining new business. And we should look at what's available locally, particularly through the local enterprise office, who are hosting lots of webinars, and indeed the Chambers of Commerce. I think it's important to, despite the fact that we can't physically attend meetings and so on, that we keep in touch with businesses in the local area, and I think and support them in particular.
Okay, thanks. Question probably for you, Simon, again, or is with such an increase in expenditure worldwide money printing, what's the likelihood of hyperinflation in the future? How does the current situation compare with post-war?
Thanks, David. And I saw that question came from Alan's predecessor, John. So, John, sorry, we can't share the room this morning, but good to hear from you. So I'm not overly concerned about inflation for the time being. In fact, if anything, central banks are more concerned about inflation staying lower than has been the case already. So, for example, if I look at the ECB's latest forecast for inflation over the coming 2.5 years, not only is inflation not high, it's actually considerably lower than the ECB's target of close to 2%. So even on the ECB's own current view, not only is inflation not going to take off, it's not even going to get back to its own target by the end of 2022. So I think while we can never be overly relaxed about these things, especially over the longer term, and I guess that was partly my point, which is that it would be wrong for us to presume that interest rates and borrowing costs are going to be as low as they currently are, because at some point there will be some normalization in the economy, which means that inflation over time will start to go back up. But for now, I think I'm more concerned, and I think policymakers, including in Ireland, including the ECB, are more concerned about doing enough to keep the economies going rather than concerned about inflation. If we end up at some point in time over the next couple of years with a stronger economy, that means that the inflation outlook is a bit stronger, then I think that wouldn't be the worst possible outcome. And I think everything that we currently understand about the economy is that even with all of this stimulus, even with all of this spending, the economy continues to face really difficult times. That means for the time being, there's going to be spare capacity in the economy, not a shortage of capacity. And that tells you generally to expect inflation to remain relatively well behaved rather than to be out of control. So it's not something that I would dismiss, because you can't be complacent about these things, but inflation is not at the top of the worry list at the moment. But thanks for the question, John.
Okay, thanks, Simon. Fiona, did the budget do anything regarding pensions?
No, so there was no changes around pensions, no changes to tax relief available, or no changes to imputed distributions from your pension scheme. There is a pensions commission that has been established that's going to look at obviously the state pensions and whether that's viable to continue, and obviously the age that a person enters into that. And we heard yesterday that the increase in the pension age to 67 was deferred, which is meant to come in on 1 January 2021. So there will be further news on pensions, I would say, next year.
Okay, thanks, Fiona. Back to the corporation tax you mentioned there, Simon. Are there any indications of potential impact of global corporation tax reforms of the Irish regime? How well placed is the government to protect our system, given it represents such a large portion of our tax take, and also struck indirect employment?
Wow, another good question. There's a lot in that. The quick answer to that is that so there had been a lot of momentum towards reforms in the global tax system over the last 12 months. If anything, they've softened a bit because the US administration isn't on board, and it's just really difficult to think that you can make any progress, because this has to be a global change. It can't be just individual countries or groups of countries making unilateral changes. That's a recipe for chaos. And so really the thing is on hold until the US election is resolved. The big picture, though, is that change is likely to come. And in fact, before this budget, last budget had made provision for a kind of a hit to Ireland's tax base, because one of the reforms that seems kind of likely to come down the track is that there would be a kind of a reallocation of taxing rights away from countries where the multinationals are located towards where the sales of those multinationals locate, broadly speaking. So that is going to play a role in kind of undermining our tax base. But the broad thinking on that is that that's potentially manageable. So it will involve a hit to our base. But the second pillar of possible reform is the one that maybe has the potential to be more damaging to us, and it's the one that that we need to keep a close eye on, which is the potential for there to be a global minimum corporate tax rate. And so there's a whole pile of complexity around how you define that minimum. Do you apply it at a country level or at a company level, and where the minimum rate is going to be? So the political consensus just isn't there to understand where that is. But in terms of the risks that we need to be really actively monitoring, then it's that minimum tax rate globally is the one that we need to be paying close attention to. Fiona mentioned, I think, that one of the things unveiled was this corporate tax roadmap, a kind of a strategy update. And I think that will play an important role in just conveying to people the reforms that have already been made, the significant level of transparency that operates in the Irish system, and that for a number of years now, we've seen effective tax rates, in other words, the amount that these companies actually pay, in Ireland has been not far from the actual headline rate. And they're all, I think, things that the government will be emphasising in its ongoing stakeholder engagement with people like the OECD and the European Commission.
Okay, thanks, Simon. We've got tons of questions in. Thanks very much. We won't get through them all now due to time constraints. Now we just ask two more questions to do with the cars and probably related. Annie mentioned the extension or ending the BIK relief on electric cars supplied by a company. And then, but the cost of cars, will they be increased as a result of the budget? So maybe, Fiona?
So BIK and electric cars, it was previously extended to the end of 2021. So the government may revisit that at next year's budget, and obviously with the introduction of the new VRT system and trying to encourage people to buy more climate efficient vehicles, that there might be a move away from that, but we'll have to wait and see. And obviously the VRT changes introduced, and obviously with the changes in motor tax, we will see the price of a car going up. So in the media yesterday, it talked about changes of your average family vehicle going up potentially €1,000. It obviously very much depends on the type of car you drive, and if you have a guzzler of a machine, obviously you're going to see that the cost of a new car is going to increase.
Thanks, Fiona. And the last question, I'll put it to you, Alan. I've always been confused by VAT. Does the reduced VAT rate benefit the customer or the business, or both?
Yeah, so if you look at the recent VAT reduction from 23 down to 21%, the minister clearly indicated that he wanted to leave that to the individual businesses to decide whether they passed on the reduction or not. And that was based around supporting businesses and would have had their margins improve. So in relation to the 9% reduction, I'd imagine that what will happen here is that the hospitality industry will pass on the reduction, and it will reduce the cost of accommodation and food in restaurants and hotels. So, but again, it will be a matter for individual businesses to decide on that. My guess would be that a lot of those savings will be passed on, and there'll be lots of bargains for customers out there from the 1st of November. Hopefully that's what happens, and that's what we would like to see.
Okay. Thanks, Alan. As I said, we've got lots of questions in. Unfortunately, we won't be able to get through them all. For the questions we haven't answered, one of the panel speakers will get back to you and give an answer to your question. So look, we leave it at that. I'd like now to thank very much our presenters, Anne-Marie Cox of Ulster Bank, Fiona Murphy from RBK Chartered Accountants, Simon Barry, Ulster Bank, Alan Shaw, Chambers Ireland and Athlone Chamber. We'll be sending out a recording of the webinar and the slides later today. If you have any questions or queries or require assistance on any particular matter, please do reach out to ourselves, Chamber or Ulster Bank. Thank you all very much for attending. Wishing you the very best. Take care, and we'll see you soon. Goodbye, everybody.